Hi, I'm Doug Holtz-Eakin, President of the American Action Forum, and I want to welcome you to this discussion on the U.S. housing recovery and what we can learn from Florida. Both those in the audience, appreciate you being here, and the many we have watching online. And for those who are into social media, I have been instructed to point out that we have a Twitter hashtag, AF Housing, for this event, and you are to fill the airwaves with discussions of what's going on. We're going to have some remarks and then two panels, and it is my distinct pleasure to introduce our keynote speaker, former Senator Mel Martinez. He is currently the regional chairman for J.P. Morgan and also the chairman of the J.P. Morgan Foundation. It's part of his long-standing interest in charity and is on the board of Habitat for Humanity. His record really doesn't need a lot of explanation from me. I think from the purposes of this event, the most interesting thing is we have the privilege of a former Secretary of Housing and Urban Development to talk to us about housing markets in Florida and the United States. And he's going to talk a little bit, and then we will have an opportunity to ask questions. When you do, I would ask you to do a couple of things. Number one, stand. Number two, wait for the microphone to arrive, because if you don't, the people online cannot hear the question. And then number three, ask your question in the form of a question with a question mark at the end. Thank you very much, and I want to welcome to the stage Senator Martinez.
Well, thank you very much, and good morning to all of you. And I want to thank Doug, first of all, for inviting me to be with you today, and also for his nice introduction, but most of all, for all the work that he does and has done. For a number of years, we've known one another, and it's been my pleasure to get an opportunity to work with him from time to time, and I find him to be always interesting, always obviously watch him on TV as well, and not shy about opinions, sometimes correct and sometimes a little off the mark, now and then. We've won elections, lost elections together, and all of that good stuff. So anyway, actually, the winning side hasn't been all that flourishing of late, but let's hope. What the heck. But, I'm also pleased to be involved with the American Action Network and the work that they've been doing. Norm Coleman, Senator Coleman, a former colleague and dear friend, is also very involved. And it's been a good thing to highlight important economic issues and so forth. As a former HUD secretary, I'm one who believes that owning a home is just one of the real fundamental aspirations that most American families still have. And homeownership has, over the years, enabled families to be able to build wealth and do wonderful things for themselves. And it's totally ingrained to me as part of the American dream. Certainly was a part of my American dream and my family's American dream. But, with the collapse of the housing market over the last several years, we've seen a tremendous amount of economic hardship that followed, and many are understandably challenging the fundamental assumptions of whether or not we really continue to have the same role from home ownership that it has had in the past, and in today's society going forward, is it going to have the same place? So the question is asked, have we overemphasized home ownership as a means to acquire wealth? And when is home ownership appropriate for a family? When is it not? And also, the role of the federal government in all of this. Are we doing enough to support rental housing? Is the future going to be as geared to home ownership as it has been in the not so distant past, or is it going to be more focused on rental, and should government policy be focused on that as well? So what I'm going to do is talk a little bit about Florida, but then also talk a little bit about the national picture. In Florida, let me say that we have been clearly ground zero for a lot of the things that have afflicted the housing market over the last several years. There's no question that we have really seen the eye of the storm here, no question about that. The median home price this year, however, is up 7.6% nationally. Around here, I read in the morning paper, this is right hot off the press from the Orlando Sentinel, home prices seem to be up about 15%, which is quite encouraging and obviously ahead of the national curve. But I think in other parts of the state and in pockets throughout the state, and the situation continues to be very, very difficult. We're also seeing some positive signs of recovery. We have clearly a long way to go because the downturn was so severe and so deep and so intense. As of September, Florida continues to lead the nation in foreclosures. 3 out of the top foreclosure cities in the United States are Miami, Fort Lauderdale, and Jacksonville. In Greater Miami alone, 16.4% of homes are in some stage of foreclosure process, and 23% of homeowners are at least 90-day delinquents on their mortgages. And believe it or not, those numbers are actually an improvement over the same time last year. At the same time, all of those condominiums that were purchased, that were built just before the collapse in 2008 or so, so many of them have been purchased and are no longer. So the inventory has been used up dramatically. A lot of that coming from foreign sales and foreign investors and foreign participants in the housing market, particularly in that Miami area. So in Orlando, I think things are a bit better. The new home market just posted the most construction activity in 4 years, and the new home move-ins are now at the highest level since December of 2008. So it's encouraging, but it doesn't mean the crisis is over, and it certainly doesn't erase the financial losses that so many have suffered. And it doesn't mean the federal lawmakers can relax and do nothing. So, in my view, housing is really tied to the economic recovery that we will see, whether in Florida or whether in the country at large. I really believe that housing recovery is at the heart of economic recovery. So as much as housing contributed to the current difficulties, it can also help lead the way to a new era of prosperity. And I think in the meantime, we have to find a way to put the right policies in place. A stable and strong housing market that avoids the mistakes of the past will directly translate into more jobs, higher family incomes, and more vibrant economy. So over the last several years, there's been a lot of attention paid to a lot of facets of this economy, but not enough, in my view, to the whole housing policy bucket. And while I know that there have been courageous attempts and well-intended attempts to deal with a crisis, the overall policy has got to be right in order for us to restore the health of the housing economy. So now that we're past the elections, it is my hope that Republicans and Democrats will join together and make housing a top national priority in full recognition of its intimate link to America's economic renewal. There are several specifics but interrelated areas of housing policy that I believe deserve immediate attention, and let me go over these. First of all, overcoming the scarcity of credit in today's mortgage market is one. Mitigating the impact of the foreclosure crisis is the second. And third, establishing a clear vision for the future of a housing finance system. So let me take a moment to share some thoughts on each of these three issues. Regulatory uncertainty and the scarcity of mortgage credit is a real serious problem. Today, young families who avoided the storm want to own a home and are ready to take advantage of the lowest interest rates in the decades and the lowest home prices in some time, and they can either not afford or cannot qualify under the new standards required to enter the mortgage marketplace. So if you think about it, in the span of 72 months, we've gone from, I guess you would call it the Wild West, where you would come in and not have to show that you had an income. You didn't have to really even show proof that you had a job, and a bank would, with little question, that you'd walk out with a mortgage. And today, in that same, in this changed environment, you can have a young couple go in there and bring in their pay stubs and do this, that, and the other thing. And in fact, they will get enough information to get an FBI background check, and they will get a rejection on their mortgage application. And so, surely, I'm with J.P. Morgan Chase. We, as a bank, and I know many of you in the industry understand that we cannot repeat the mistakes of the past. We have to be more careful, and things have changed. So the fact is that there has to be a cautious approach to underwriting. But it's also true that the uncertain, inspired by the future prospect array of new and potentially restrictive banking rules, is having a profoundly negative impact on credit availability today, and is stalling the housing market recovery, in my view. So if these rules remain in the current form, as originally proposed, the effect on credit availability could really be absolutely devastating. The source of much of this uncertainty is the Dodd-Frank legislation, which was intended to protect consumers from the past failures in the mortgage marketplace. And on paper, the motivations of this law make sense. But as is the case with most federal laws and regulations, it's really the fine print that counts. And there are a great number of rules in the pipeline, and for all of them, the overriding imperative is to strike a right balance between protecting consumers from abusive lending practices while ensuring that mortgage credit continues to flow to those who need it and want it and who can bear the financial obligation of a mortgage. So what's troubling about Dodd-Frank and other elements affecting bank policies is disconnect between idea and execution. Few in Washington have the full picture of how all of these complex rules and requirements will interact with each other, nor does anyone have a good handle on what their combined impact might be on the willingness of banks, especially community banks, to extend mortgage credit. So, to me, an understanding of these issues is critical to reducing the uncertainty and advancing policy that will spur the housing market to the kind of robust recovery that I think we all want to see happen. So I would have a suggestion for our newly re-elected president after the holidays and after Inauguration Day and all the parties are over and Congress is back to work. I would encourage him to issue an executive order directing the Department of the Treasury in coordination with the federal bank, with all of the different and various federal banking agencies, to inventory all of these new rules and regulations that have come into being. Direct the agencies to assess the likely impact of these rules on mortgage lending with a focus on availability and affordability of mortgage credit. And then ask the Treasury within 60 days to report back on this assessment, but not just with the assessment, with a concrete action plan to get mortgage credit flowing again. I think that would do wonders to clear up this regulatory morass that we have been in the middle of. Another area that continues to command attention of policymakers is the problem of foreclosed and distressed properties. Economists predict U.S. foreclosures will continue to mount, especially now that the banks and state attorneys general have settled many questions regarding the foreclosure practices by the banks. With many of these questions about the practices resolved, financial institutions will be pressed to clear their backlog of troubled properties. Over the past few years, the Obama administration has unleashed a number of foreclosure prevention and relief programs, all very well intended, and some have had some significant impact, others a smaller impact, but all of them have had some impact. None of them have really fixed the problem. So recognizing that there are no magic remedies or quick fixes, I want to make a few suggestions on some things that might help some families. Number one, I would suggest why not consider utilizing interest rate deferment as a way to improve the long-term performance of deeply underwater mortgages. Now, clearly as home values improve, the underwater problem will become less and less over time. But it's still out there, and it will still remain with us for a good period of time, unless we take some action to do something about it and get it moving again. So to help reduce the number of strategic default by borrowers who still have the financial wherewithal to continue making mortgage payments, Fannie and Freddie could offer an interest deferment when the mortgage far exceeds the home's value. And over a defined period of time, perhaps as much as 5 years, the borrower would continue to pay the full amount of the mortgage, but on the payment, it would be applied solely to reduce principal. In other words, any interest payment due will be temporarily deferred. Fannie and Freddie would no doubt incur some costs related to this, as they assume the responsibility for making interest payments to their investors. But over the long term, they may realize substantial benefits as borrowers continue to make their timely payments on principal and fewer mortgages will go into default. Second suggestion seeks to protect local home values in neighborhoods hit hard by foreclosures. And those of you here in the Orlando market know exactly what I'm talking about. It's an increasingly important issue as the government looks to bulk sales of foreclosed properties in many instances. But as you might imagine, foreclosure puts a big dent in the value of a home, and it can dramatically reduce the price of a home and what it can be sold for. In fact, a recent MIT Harvard study concluded that foreclosed property reduces the value of the house by 27%. So today, sales of foreclosed properties continue to be recorded as comps or comparable home valuations in the appraisal of non-distressed properties located nearby. This practice depresses home values in the surrounding neighborhood and impacts the ability of potential home buyers to secure adequate financing. So to help remedy this problem, Fannie, Freddie, and the FHA could simply refuse to accept sales of foreclosed homes as valid comps. This would force an upward reappraisal of the non-distressed homes. In those markets where the volume of home sales is modest, thereby requiring the use of foreclosure sales as comps, an alternative approach might involve simply bumping up the sales value of a foreclosed home by an appropriate amount. And finally, why not encourage Fannie, Freddie, and the FHA to adjust their underwriting standards for well-qualified self-employed individuals? The self-employed do not have a steady paycheck that comes in week after week, and a lot of times we're seeing people in this segment of the population, small business owners, self-employed, who just don't seem to qualify, not because they can't have the wherewithal to pay the mortgage payment, but simply because they don't have the right documentation. It doesn't fall into the right boxes. There are 14.5 million Americans that are self-employed and either working in incorporated or unincorporated businesses. And so, without increasing the risk to Fannie, Freddie, and the FHA, they could make adjustments to their underwriting criteria that acknowledge the unique income documentation challenges faced by those that are self-employed. Now, each of these proposals can be implemented administratively without the need for congressional action, and thank goodness for that, because we know where that would go. And better yet, none requires the appropriation of any additional public funds, both which I like. Over the long term, our country must redesign and rebuild its broken system of housing finance. In many respects, this system functions as the motherboard for all of housing in the United States, linking secondary market investors in places like London and Tokyo, and frankly Beijing, to homeowners in Lincoln, Nebraska, Tallahassee, Florida, and even places around here. So this complex circuitry of mortgage originators, servicers, securitizers, and guarantors all work together to form a powerful machine that produces a wonderful benefit. And we've seen the benefits of this. But before we look to the future of housing finance, we should reflect on what lessons we can draw from the past. So here's a couple of my conclusions. First, if it seems too good to be true, it probably is. And at the height of the housing boom, many borrowers and lenders were absolutely convinced that home prices were heading in one direction and one direction only, and that was up. And I will have to make a confession here that I, as HUD secretary during that period of time, although I wasn't there in the absolute crazy times, I was there from 2001 through until 2004, and we did see an escalation in home prices. I remember being asked from time to time about a housing bubble, and I would ask our economist at HUD, our FHA commissioner, an academic guy, people that I would come in contact with. There's no such thing as a housing bubble because housing markets are all separate and different. Well, guess what? We did have a housing bubble. And we had not seen a decrease in home prices all through the post-World War II years. But we now know better, and we know that, in fact, it can happen. And so the expectation that everything is always going to go in only one direction cannot be any longer a part of our thinking. So it worked out for a while, but then the laws of gravity took over and house prices began their downward slide that we're all so familiar with. And so we can't make this mistake again. Any future system of housing finance must be resilient enough to weather the inevitable periods when the market takes a drop, even if it is a big drop like we've seen. So second, prudent underwriting is absolutely critical. In fact, it is the foundation for a sound system of housing finance. I'm still a big believer in the power of home ownership to help lift families into the middle class. But during the height of the housing boom, many lenders abandoned prudent underwriting under the guise of promoting home ownership. And yes, in some instances, federal housing policy encouraged this practice. So finally, protecting the interest of the taxpayers, I believe, must always be paramount. And the taxpayers have paid dearly for the conservatorships of Fannie and Freddie, to the tune of about $150 billion to date. And what are the chances of recovery? Well, we will wait and see on that. Business models in which gains are privatized and risks are socialized do not work. The Fannie and Freddie model broke, and we need to come up with a different one. I had the good fortune of serving now on the Bipartisan Policy Council's Housing Commission. This is a commission that's come together to try to deal with thorny issues of national policy outside the governmental sphere, and I'm pleased to serve on this commission. The four co-chairs of it are Secretary Henry Cisneros, a Democrat, former HUD Secretary, Senators George Mitchell and Kit Bond, former senators, I should say, and myself. And the four of us are joined by 21 other people in a bipartisan basis to come up with solutions to particularly the housing finance issues that we have been discussing. This commission will issue its report early next year. We're thinking around mid-February, actually, to release our report. And we hope that it will have an impact of some significance on the potential for legislation. We believe that currently, some of the conclusions that our group has come up with is that the federal government clearly is playing too large a role in the housing finance system. Greater federal intervention in the housing market was necessary when the market began to collapse. But the dominant position held by the federal government today is really unsustainable over the long term. figuring out how best to encourage private capital to assume a greater role of the credit risk in housing finance is a continuing focus of our work. Consider these facts. In 2010, purely the private sector mortgage origination constituted only 12% of all originations, compared with 53% 10 years earlier in the year 2000. Loans guaranteed by FHA and the Department of Veterans Affairs, combined with Fannie and Freddie conforming loans, were a staggering 88% of all originations in 2010. In 2011, securities backed by Fannie, Freddie, Ginnie Mae constituted 97% of the mortgage-backed securities market, with non-agency funds obviously only 3%. In other words, the private label MBS market has virtually gone the way of the dinosaur, and we need to bring it back. So getting private capital off the sidelines and back into the game, I believe, is imperative. The direction we must take is clear. Fannie and Freddie should unwind in an orderly fashion, and we must establish the conditions that allow the private sector to step in and fill the gap as the government's footprint becomes ever smaller. Transition to this new, less government-centered system will take time. The housing market remains very fragile, and precipitous action could easily push the market into a state of further disarray. But in the short term, there are steps we can take to help move us closer to the goal of greater private sector involvement. Congress, for example, should lower the loan limits for Fannie and Freddie and FHA to allow larger loans to flow to the private sector. As it has started to do, the FHA should also gradually increase the guarantee fees that Fannie and Freddie charges lenders, moving the government pricing structure closer to the level one might expect if mortgage credit risks were borne solely by the private capital. And FHFA, the governmental body that is the conservator to Fannie and Freddie, should continue shrinking the size of the Fannie and Freddie investment portfolios. That was, to me, as former HUD secretary, as I worried about Fannie and Freddie, and I was one of those that were being told I was crazy for suggesting that they presented a systemic risk to our economy, and you know, trying to get a much stronger regulator upon these entities. It's absolutely patently clear that the investment portfolio was one of the great problems that these entities had. So it's been more than 4 years since the federal government first nationalized Fannie and Freddie, and yet Washington still has no clear plan for the future of housing finance. So next year, Democrats and Republicans must begin to bridge their differences, find common ground, and make housing finance reform the kind of top national priority that it deserves to be. And yes, it's my hope that Congress and the administration will find the Commission's final recommendations of some value as they engage in this important work. So, to conclude, and I'll be happy to take a few questions after that, the challenges in housing today are so numerous and difficult that they may seem overwhelming. In fact, I think much of Washington's inaction on the housing system from the past several years has been because of the very complexity and the lack of easy answers. So it's quite natural to convince ourselves that we should put this problem off to another day when the timing might be better, the conditions better suited for change. Of course, as we well know, these days really never come. Although those of us here may disagree on some of the specific policies that we should pursue, I think we all agree that housing is just too important to be put off to another day. For the millions of families struggling to stay in their homes, for the millions of young adults who cannot get a mortgage or find affordable rental housing, for our nation's economy whose growth depends so much on a vibrant and stable housing sector, next year must be the year that housing returns to prominence on the national stage. So with that, I'll be happy to take your questions, and thank you very much for having me today. Yes.
With regard to using distressed sales and foreclosed sales as comparables, wouldn't a simple convention be to just divide by 0.75 and use the result of that division? Meaning if the house sold for $75,000 on a distressed basis, you count it at 100.
Right.
Wouldn't a simple convention like that help clear out some of this logjam?
Well, I'm suggesting that in the event that you couldn't have enough, I mean, if you have enough comps that are non-foreclosure, then throw out the foreclosure comp and use the others. But if you don't have enough, then do exactly what you're suggesting. Either way, I think it's a great deal better than what we're doing today, which is artificially depressing home values. And we've been doing it now for years at great detriment to the housing market. And as we look at this recovery that's coming, and frankly, in my view, we have pockets of great situations, the inventory, for those of you that are local in Winter Park, in College Park, in some of the neighborhoods where a lot of young families want to live, you're not going to find a lot of inventory. But you can move out to Avalon Park or to Coy, and there's plenty of areas out there where you can still see a lot of inventory. So it really has to be something that we look at overall as still something that we need to address. So I would agree with you. I think that should be part of what we should do, and that can be done administratively. There's no need for any laws to change there.
27%, that's 73, just round up to 75%.
Sure. I mean, there are a number of ways you can do it, and all of them would make a lot more sense than simply taking a foreclosure into account that is going to then distress the values. Yep.
Senator, good morning.
Good morning.
I'm Ross Bennett, past president of the Mortgage Bankers Association of Florida. I'm going to try to end this with a question mark, but first a statement. We need to address in the lending industry the sort of Damocles that's hanging over everybody's head, which is known as QM and QRM.
Oh, yeah.
We will not get private capital back into mortgage banking and lending until those issues go away. We are under assault daily with repurchase demands from our investors who will not buy loans today that are run through Fannie, Freddie automated engines. Those loans are not saleable. They have lender overlays. So it's great that we talk about easing the guidelines for the agencies. But with less than 20% of the American population right now being able to qualify for a mortgage under the current environment we operate in, and the war on capital coming into mortgage banking, what can we do as a group to let Washington know that housing will not recover until these guidelines go away? Thank you.
Well, I think you hit on an excellent point. I mean, I alluded to QM and QRM in my remarks. I didn't want to, I could have made the whole talk about QM and QRM, frankly. And it is a huge problem. And I think that a clear definition of QM that gives certainty to the financial world that there's not going to be, a got-you sort of game once they make a loan, I think is really, really important. So framing it in a way where you have a safe harbor and where that safe harbor is clear and unassailable, I think is what we need to have to give certainty to the marketplace. I'm a part of a large institution, and we can sort of swing it a little easier than the smaller lenders. But the fact is that we don't want all the business. We don't need all the business. We would never get all the business. You need the smaller players in the marketplace to be effective, and in order for them to be effective, you need clear rules of the game. So while Dodd-Frank was well-intended in saying that there should be qualified mortgages, given to people who actually qualified, it seems sort of ludicrous to suggest you need a federal law and then a regulation to implement it in order to tell bankers what they should know, which is you lend money to people who have the ability to pay it back. Sort of fundamental. But at the same time, given the experience of the past, something perhaps should have been done. However, the implementation of this is absolutely critical. I was disappointed that it wasn't done earlier. It was put off until January. I think it'll come about in January. But I'm still not clear on where they're going to come down on QM. There's an awful lot of well-intended consumer groups out there that would like to see this not be a safe harbor, but be a rebuttable presumption, which then gives rise to the potential for a lawsuit. To me, that would be absolutely devastating to the availability, to do the very thing I'm talking about, bringing back the private sector into the mortgage marketplace and private investor capital into it, and you can have then confidence that MBSs will be attractive to private investors. And so, and the QRM is, first cousin, similar problem related to the mortgage-backed security world. So you're right on it, and I would say continue on your path. It's very critical that over the next month or so they hear voices that say, give some certainty to the marketplace and don't play games with this. Yep. Yes, ma'am.
Good morning. My name is Barbara Hampton, and I'm a realtor with RE/MAX, and I work with a lot of first-time buyers. We are competing against so many all-cash buyers who are buying from hedge funds, the hedge funds are coming from Dubai, the hedge funds are coming from Goldman Sachs.
Yeah.
Our prices have gone up 15% because the inventory is being swept off the market before the people who you claim we have an interest in serving, the homeowners locally, can even get a shot at it. FHA buyers, we go 7, 8, 9 offers before we can possibly get a house.
Yeah.
And the prices keep going up, and the availability is going down. My question is, what are we doing to protect the local people who want to get houses? And finally, Texas and Vermont, under the same federal regulations, managed not to have a housing crisis that California and Florida did. My question to you is, what part do our local governments have within our state levels of transforming our local mortgage lending laws so Florida stops being the boom-bust economy that hurts our residents, hurts our developers, hurts our builders, and is not sustainable? Is that a question?
Wow. Let's see. Okay, let me start over. By the way, Richard Smith is on the Bipartisan Policy Commission on Housing that I serve on. I think you know that name, with Realty. I guess that's a different group of realty companies, but he's very active on that. So your point of view as a realtor is really being heard because he's very, very active on this, and he's the CEO of Realty, who owns a number of the different brand names of realtors. But let me say that I'm not sure there's an easy answer to that problem, but it's going to be a continuing problem, I think, because there's been a tremendous desire to lump properties and sell them in these bulk sales. Our firm, Chase Mortgage, has chosen not to play in that game. We've not done that, but I know many have. So I don't know that I have a ready answer to that problem. Maybe there's some other bright voices here that can maybe deal with that issue for you, because I am not really knowledgeable enough to tell you what the answer might be to that. Although I think it'll work its way through, but it may be 2-3 years before that happens, and that's not a good answer for you. On the boom-bust cycles, I mean, you're not trying to defy Florida history, you know. That's sort of who we are. And so I think that you had a situation in some belt states that became very attractive places with a lot of development and a lot of activity. You know, it wasn't just Florida and California. It was also Arizona, and it was also Nevada. We were kind of at the tip of the spear when it came to all of these problems. I remember when I was HUD secretary traveling to Arizona and landing in Scottsdale, and I thought, wow, this really reminds me of Florida. There was just a helter-skelter, crazy development feeling about it. Obviously, the landscape was very different, but when you were driving and there was construction here and construction there and new roads going in, and, you know, it had that same feeling that you were here in Florida in 2003, 2004. And I don't know that, well, I think one thing that would help that our local government officials could do is to improve the foreclosure process. You know, we're 36 months, okay? And I'm not saying that as a banker. I'm saying that as a policy person. Certainty and speed of foreclosures only helps reduce the problem we've faced. I mean, if we'd have quicker processes to get foreclosures to conclusion, you know, we would have had a much better or a much faster recovery, in my opinion. I think that the prolonged foreclosures in Florida, which drag on about the longest in the country, I think are a huge part of what our problem has been in the very slow recovery we've had here in our state. And so I don't know if there's an answer to Florida's boom-bust cycles. I think that's just part of who we are. But hopefully we learn from it, you know. Hopefully this one has been so severe, so deep, so traumatic that maybe there's some lessons here that the financial institutions as well as people in the business will learn, that you just can't go at it 150 miles an hour and always expect the same results. I think my time's about up, Doug, but I'm happy to, you know, thank you very much. Great being with you.
Hi, everyone. While we're getting set up here, for those of you locally, we appreciate you making the time to come. And for those of you who've traveled somewhere else, we hope that you're warmer and more comfortable here. And ready to kind of see what's really been on the front lines of a very tumultuous real estate market in the last 7 or 8 years. My name is Mary Shanklin. I'm the real estate writer for the Orlando Sentinel. We're going to have a very august panel here to address kind of where we are in terms of the economy and where Florida fits in with that. Joining us here this morning from my side is Sean Snaith. He's the director of the Institute of Economic Competitiveness at the University of Central Florida, which now I believe is the second largest university in the country. Then to his right, we have Stanley Geberer, a senior associate with Fishkind Associates, an economic consulting firm that's done a lot of in-depth analysis on how we've gotten to this point. And we're honored to have next to him is Dean Asher, is the president-elect of the Florida Association of Realtors. Just did an outstanding job last week hosting the National Association of Realtors here in Orlando. And also we're honored to have Buzz Ausley, who is the director of our local HUD office. And I'm sure is deeply familiar with many of the issues that former Senator Mel Martinez raised in the opening remarks. I'd like to start off by if we could kind of frame where we are in Florida, where we stand in terms of the economic recovery, kind of, how we've gotten here and where we have to go. Sean, if you want to start there.
Yes, I think the Senator touched on a lot of the reasons how we got where we are and where we have to go is up. Unfortunately, it's going to be a long climb, and the pace of the recovery thus far has been subdued, and so we still have quite a way to go as far as the economy is concerned. I think, Florida probably went into recession before the rest of the nation entered the recession, and we came out of recession after the rest of the country exited recession. So this has been a very prolonged, deep, and painful downturn in the economy. Tremendous job loss. We still have a long way to go just to get back to where we were prior to this crisis. The good news is we're on our way and we continue. The bad news is the pace of that recovery is just not as quick as I think all of us would like to see.
Go ahead.
I think it's important to take the effects of this recession into perspective with prior Florida recessions. We talked about the boom-bust cycle a little bit ago. And typically at the end of deep, long recessions in Florida, such as we experienced in 1975 or 1991, it takes us 4 years for population growth to get back just to the average of what it's been for the past 40 years in Florida. Because this was a deeper and longer recession, it may take a little bit longer than 4 to 5 years just to get back to the averages. I think when folks say, well, when are we going to get back to normal, we have to understand that 2005, 2006 wasn't really normal. That was an unsustainable bubble, so we're probably not going to go there again. So if we had recession, the depth and the end of the recession in 2009, it could take 4 to 5 years just to get back to the average. And that would be growth levels about 3/4 of what we saw in 2005, 2006. We're well on track to reach those numbers by 2014, 2015. It's just going to take us a little bit of time, and we're working through some of the inventory issues. The population growth numbers appear to be very strong. It's very hard to measure them because we have so much inventory that when you build a new house, normally you just get 2 new people. Now we have all these empty houses, and nobody can count how many people are coming in because they're just filling up the vacant houses. So it's hard to gauge what the population growth is, but we think the population growth is pretty strong. And we think because of the storms in the Northeast that it'll get stronger over the next couple of years. And we also think it's going to be very ironic that people will flee New York and New Jersey, flee hurricanes in New York and New Jersey and come to Florida. But we think that's going to happen.
You know, if you don't mind, I'd like to just, because you all have done such a great job of addressing that question, Dean, I'd like you to actually pick up a little bit about a question raised previously by the audience. I believe it's Barbara Hampton, is that right? Talking about how regular buyers really don't have as much of an opportunity to purchase because they're competing with these hedge funds that are coming in here and scooping up, you know, so much of the inventory. You're in such a good position to address that.
Well, my opening comment was going to be, I'm glad it's 2012 and we're going forward. Yeah, I mean, you know, as the organization, as the Florida Realtors is concerned, you know, we've been really in the last couple of years trying to promote international home ownership and people from other countries coming into Florida and buying homes. And so obviously with the hedge funds and the large bulk groups that are buying, that's basically brought our inventory down. The median price hasn't risen as much. We got a lot of pending sales, but our inventory has shrunk drastically. And so at one time, just in the Orlando area, we were up to about 16, 18 months in inventory. You know, statewide, we're down around 5.2. In Orlando, we're down in the 4%. And so really when you take 4 or 5%, no matter where that guideline is, and take a look at it, when you take out the homes that probably will never sell and the homes that you can't come to an agreement on, you've got a really, really tight market in Central Florida and across the country and across the state. And so, you know, I think when you look at it, I mean, you know, you flip the side around and you go, okay, you've got people that are living here that have owned homes for 10, 15, 20 years, and let's say they paid $300,000 or $400,000 for a home, and they know it's worth $200,000. If they can get less inventory and they can get larger sales prices, those people are happy as the residents because they want their homes to appreciate. And the crisis that I think is still looming out there that could happen in the housing industry is that we've been promising these people for 5, 6, 7 years that it's going to get better. And things are going to get better in Florida. And what's happened is that the prices haven't risen much, and that's a whole different story about liquidity in the marketplace. But they're like, hey, you know what? If this doesn't get any better in the next, 12 to 13 months, I'm just going to walk away from my house because that's what everybody else does. And so I think that, we've encouraged people to come from other countries and investors to buy in Central Florida. That makes, in Florida as a whole, that makes the market much better, and it should get back quicker to where we need to be. And I think that's the looming thing out there is that, if years ago and back in 2005 or 4, if you were down in Miami and you drove going to South Beach and drove over the bridge, it looked like a kid's erector set. And you were going, wow, who in the world is going to buy all of these condos? And literally, Miami has recovered faster than any major city in Florida in the housing market. And so they've got new construction that's happening in Miami where we have a little bit of that here. I think the home builders are years from recovering. We've got some condo projects in downtown Orlando coming, but Miami, they got cranes back up, and they've had a lot of Brazilian buyers in Miami. So I think you got to balance the good with the bad.
Right. Yes. We definitely have our foreign investors, but we also are a judicial foreclosure state, so it is such a mixed bag. Buzz with our Orlando HUD office is. I feel like you're in a pretty good position to perhaps address how you think some of the federal policies have affected, for the better or for the worse, our recovery.
Well, the federal policies are what we see in action here. Some of them have been well-intentioned, as Senator Martinez said. I just have to say, remember, it wasn't very long ago he was Mel, and you'd just see him on the sidewalk and say, hey, Mel, and pretty soon it was, hey, for me, Mr. Secretary, and then Senator, and so...
Is he back to hey, Mel again?
I can't get back to hey, Mel. Honestly, that's kind of over my head. There are a lot of policies in place. Some of them work pretty well. Some of them work in isolated circumstances. I don't think that federal policies have impeded anything. I think the fundamental here, the basic here, is the economy and jobs and income. And one of the things that we all know, I'm not used to talking to a room full of people with coats and ties on. I talk to a lot of our countrymen and countrywomen who are in trouble and need help with their mortgages. We know the absolute interdependency for recovery on everything that's going on. It's the economy, it's the jobs, it's retail. It all goes together in this whole housing is just a part of it. Housing is one of the most observable aspects of it. And I see our countrymen and our countrywomen come to meetings, and I've talked to thousands of them, who need help with their mortgages. And different programs help, and we're probably in a better position than we've ever been from a program standpoint to help them. So please understand this distinction. The things that have happened up till now are really important. What I'm dealing with is simply this. It's my goal and our agency's goal to stop preventable foreclosures from now on. And the way that can be done is through a myriad of programs. But it all comes down to casework. It has to be done on a one-on-one basis. I know how frustrating it was to talk to groups of people throughout our communities, and my responsibilities are for Central Florida and over to Volusia and then down south through St. Lucie and now temporarily for the northern part of the state as well. To talk to groups of people about programs and then realize that they had to understand how those programs would fit their own individual circumstances. And so the way that has worked best is through good old HUD provides financing to HUD-approved housing counseling agencies. They provide their foreclosure counseling services free, and they're good. Here's what makes them effective. Stop me if I get too far off in this direction.
You're on the front lines.
Here's what makes them effective. Suppose you're a room full of homeowners who need help with their mortgages. Intuitively, you know every case is different. Mine's different than yours. Yours is different than his. They're all different. And somebody has to do the casework. Somebody has to look at the file, determine what the realistic financial situation is, and then present it to the lender to work on it. Probably the least qualified, the least able person to do that is the homeowner who needs help with their mortgage. They're scared, embarrassed, not aware of what goes past the top page of their mortgage documents. But the HUD-approved housing counseling agency, HUD funds them, and then they operate at no charge on foreclosure services. They know the lenders. More important, the lenders know them. So that when a HUD-approved housing counselor, an agency called Wells Fargo, J.P. Morgan, any of the major lenders, and almost all of the smaller lenders, when they call, the lender knows they're talking to someone who has a rather comprehensive understanding of the issue that they're going to talk about, rather than a homeowner who understandably is angry or scared or all those other things. So they're very, very effective in that. Not as a generality, but well over 50%, and in many cases up to 70% of HUD-assisted transactions for modifications with lenders comes in at about 70%. So
that's quite
as a resolution,
track record.
that's very important. So I think it's useful to keep that in mind as we go forward.
Thank you. Certainly policies make all the difference, but what happens on the ground floor is sure key. I'd like, Sean does so many travels around the country. If you could address a little bit about how you feel like the recovery has differentiated for judicial foreclosure states like Florida as opposed to non-judicial states like California.
Right. Well, I mean, I think the process that's in place here prolongs the time it takes for foreclosures to get through the system. I think that the moratorium on foreclosures prolonged a process that simply had to happen, and I've likened it to, slowly pulling a Band-Aid off of your forearm so you can feel each individual hair follicle being torn from your skin, as opposed to just getting over the process as quickly as possible and moving to the other side. What I do hear, speaking to state banking associations around the country, is what the impact of policy has been, specifically financial regulatory reform and the Dodd-Frank Act. Community bankers, no matter where in the country I speak, they tell me the same thing. Prior to this, I would have a part-time person working on compliance. Now I have to have 4 full-time people working on compliance. So we've foisted a tremendous burden on a sector of our economy that, yes, needed to have some problems addressed, but we also need the lifeblood of credit pumping through our economy, and we're restricting that flow. Housing's a very complex problem. We didn't hear a lot of talk about it during the election, virtually none, because it doesn't lend itself to soundbite solutions. And I think we still have a lot of hard work from the federal level all the way down to really fix what was wrong and led us to this crisis and recession that came after it, and try to get back on a more healthy trajectory as far as growth is concerned, while trying to prevent some of these mistakes from recurring.
Yeah, certainly the mortgage availability has already been a recurring theme here this morning. Another thing I want to touch on, and we'll open it up in just a couple minutes to questions. Wanted to look at the foreclosure inventory. It's been such an issue here, kind of the differentiation between, how different mortgage servicers and lenders are releasing those properties and how that's affecting the market. Stan, if you could speak to that.
Well, in terms of the foreclosure volume, there's probably been 1 million foreclosures approximately in the state of Florida. It's almost 10% of the total housing inventory. And I think what we're finding is that in the core of the major urban markets, these are places where the prices are rising, where the jobs are being formed, and so the housing markets are improving more rapidly in those places, particularly places that are supported by international buying and investor buying. So the core metros in the state of Florida, the foreclosure process in Orlando in particular, and Miami in particular, are improving much more rapidly than the fringe markets throughout the state. In the fringe markets throughout the state, places that are the tertiary counties adjacent to major metro areas, Citrus and Pasco and South Osceola County, Clay County, Putnam County, places that you don't hear of very often, the volume of remaining inventory of distressed and foreclosed properties is very, very high. It's 80% of local sales in some instances. And there's a much greater problem in those places because now those places are, with high gas prices, those places are a little too far out for people to want to travel. And since the prices in the core markets have fallen, you can now afford to buy in the core market. And so for a longer time, the prices will remain depressed in the outer areas, Hendry County, remote eastern Lee and Collier counties, places like that. I think the foreclosure problem is going to remain for a while. The prices will remain more depressed, and the demand for product in those places will be lower because it's now much more affordable in the core markets where the inventory is much reduced and the prices are much reduced.
Very good. Dean, I'd be interested in what you would have to say about that as well. You are in positions where you get to hear a lot from these lenders, and you get to hear a lot from them about, their intentions on releasing the inventory. What are you hearing?
If we had all day, we have a great discussion. Mary and I talk quite often from the newspaper side of things, and that's Mary's first question every time I talk to her. So where is the 600,000 homes that are in shadow inventory? When are those going to be released to the marketplace? And so no one really knows what the real answer with that is. And so when you talk about the tightness of the market and what the inventory is, Mary always alludes to it, is that really a true picture of what's happening out there, or is that false? Because at any given time, the lenders could release, another 50,000 properties or 100,000 properties, and it would dilute the marketplace. And so, it's like, on another front, we manage, condo and homeowners associations. And so these banks will hold on to these things for 2-3 years. And so, when you ask the lenders, okay, when are we going to release those properties, they give you no answer. And it's the same answer we ask, okay, when are you going to put some more liquidity in the marketplace? When are you going to have better investor financing or secondary financing? And it's always like, well, we're looking to see what the other banks are going to do. Oh, well, this bank is doing that. Oh, really? I need to check into that. So they've never given us a time frame of, hey, this is when it's going to be. At any given time, as we've talked on the telephone, that, between December, January, and February, we could wake up and the market may expand to 7-8% as far as what the inventory is. But if I got 1 second to go back to the judicial, non-judicial.
Right.
At the National Association, we have a lunch, which is the large 7 or 10 states. And so you can only imagine that in that lunch, there is California, Florida, Nevada, Arizona. And so when we tell our colleagues out there that, hey, we have, it takes 2 years to foreclose on a home, they cannot believe that. And so when we, from the Florida Realtors perspective, when we've gone to the table and said, maybe we ought to start bringing this up and talking about it, then it comes from a housing issue, what's good for Florida, for housing, and for homeowners, to a political issue. That's not the right path to go on, because if you change that policy, then people won't have the fair ability to try to save their home. And so, it becomes a political, but it's really hard, and that's why California, I think, in some areas has recovered a lot better than some cities in Florida have because of the foreclosure. And so, that's something we could sit up here and talk about all day. And Buzz may say, hey, you know what, I think that we ought to give everybody the opportunity to keep their house, and then other folks would say, hey, we can't get back to recovery as fast, if banks are holding on to their inventory for, 18 months, 2 years, 3 years. Some that, their philosophy sometimes is, hey, you know what, I don't want to pay the taxes, I don't want to pay the homeowners fees, and if somebody will just stay in there, live in there, and pay the electricity bill, then we're okay with that right now. And so is that right or wrong?
Yeah. What do you say, Buzz? Do you think that it is, you're doing a service to homeowners to give them their day in court? Do you think that that's extended our recovery as a judicial foreclosure state?
It's easy to think that, but when you look at the state of Georgia, which is not a judicial foreclosure state, they have a very heavy inventory of foreclosures. They have a high rate of foreclosures and a lot of foreclosed homes in inventory. So it looks like it would be intuitive, and it doesn't seem to make that connection. One of the things, of course, that happens when you have an 800-day delay between default and the filing of a foreclosure suit and the actual sale of the foreclosed homes, when that's 800 days, a lot of the urgency goes out of it from the homeowner's standpoint, and they behave in a different way. They know they learn fairly quickly they've got 2 years, and so it has that effect. I didn't give you quite a complete answer on the federal programs, but for foreclosure prevention, and because we want to stop preventable foreclosures, not stop because some just can't be fixed. But the hardest hit fund, which is administered by the Florida Housing Finance Corporation, which is the state's housing finance authority, received $1 billion from the federal government, from the Treasury, to assist Florida homeowners, and they have selected 52 intake organizations for the hardest hit fund, which provides two things: temporary payments for people who've lost their jobs and think they can get them back, up to $18,000 for that amount, and also $25,000 as a separate amount to get caught back up on the mortgage. So the hardest hit fund in Florida, $1 billion fund, is active and underway. The other meaningful casework, and again it's casework, the other meaningful casework resource is the lenders themselves. J.P. Morgan Chase has 15 or 16 home ownership centers where people go directly to them and talk about their loans, which gets over that communication gap. Bank of America has them, and I think mentioned that Wells Fargo will have an event tomorrow at the convention center for the express purpose of meeting with homeowners who are delinquent. We have in our community, 17% of the mortgage loans are over 90 days in that serious default. 17%.
Yeah, a lot of programs, a lot of money available out there. How much of that money will be distributed before it expires will be interesting to see. At this point, we'd love to hear your questions here from the audience. Please, the gentleman there. You can.
My name is Carl Van Diver. My comments are for Mr. Ausley's first comments, and my apologies, but I think it was completely wrong what you said about we need more federal policy, more programs to help people stay on their loans. Unless
if you think I said that, you misunderstood me.
Well, unless you can negotiate principal, the best thing that you can do is facilitate the foreclosure. If people can't afford the home, giving them 40 years, dropping their interest rates, anything like that, more policies, more programs, more outreach, it doesn't work. It just extends and pretends. And that's been the problem with our foreclosure process. That's our problem with banking right now. You're absolutely right. It's all tied up into the economy. But the problem right now with housing is we're trying to prevent foreclosures instead of facilitate foreclosures when it's appropriate.
I really agree with you. I don't think we depart very much. My thought is that there are homeowners who don't understand that they can be helped and put into a situation where they can afford to stay in their home. And that's what our goal is. But just to prevent willy-nilly any foreclosure, it's a disservice really to a family to extend the difficulty of not being able to stay in their home. That's a good point.
And then
Well, it's a disservice to the other party of the contract, the bank, the lender, to allow them 2 years before they get out. And I've gone through 2 foreclosures. Both times I went through mediation, and both times I tried to negotiate principal with the lender. I tried to do anything I could. I wanted to save both homes. But without principal negotiation, there's no point to it.
Thank you for that comment. If you pick up the Orlando Sentinel today, you'll see a front page story on where principal reduction is headed. But you make an excellent point that, half of our mortgages here are underwater, and that's a huge question that's being asked by our population. Go ahead. This is maybe like our last opportunity for a question, so please go ahead.
If I may, my name is Ed Hampton. I'm a developer here in town. I'd like to ask this question of Sean Snaith. How do you view the longer-term impact and consequence to the marketplace of the increased participation of private funds in the wholesale purchase of a relatively limited availability of product and turning it into rental product? Is this healthy or not? It's certainly a meaningful part of the marketplace today.
Well, generally speaking, I think it's a good thing. I know it seems maybe a bit odd to look to the same people that we were blaming for helping to precipitate the crisis to actually help us get out of the crisis. But inventory needs to be absorbed, and if that's being done by foreign investors or hedge funds, they're scooping up distressed properties. The need for rental is there. I mean, these places are being rented, but these are different investors. This is not condoflip.com and the housing bubble that we saw before, where they were buying and they were in it for a month or 2 or 3. These people are going to have to hold for a while to get their money back. And you know what? That's okay. I think it gets us closer to the other side of this crisis. So I think it's part of the solution, ironically in some ways, but it is helping us move forward.
Okay, we'll get one last one.
Good, thank you.
Yeah.
I'm Trevor Hall. I live here. I'm grandson of Trevor Pearson Hall, and during the Depression, he was an electrician at Buick in Flint, Michigan, and he fell behind on his mortgage when they cut his hours to 9 hours. And he got a letter from his lender that scared the willy out of him, but he made it in there, to General Motors Acceptance Corporation. They sat him down. They said, Mr. Hall, we understand that you're behind on your payments because your hours have been cut. We're rewriting your mortgage. We're cutting your interest rate to 2.5%. We're going to tie your payments to your Buick income. And they did it in an afternoon. Isn't there a simpler solution than all the machinations I see out there? Can't you just say, look, cut the interest rate to 2.5%, rewrite the thing, then the mortgage can be serviced by the borrower and be sold by the lender in the secondary market? Isn't there a simpler solution?
Who would like to take that?
Those were simpler times, for sure.
I'll take that one. Real quickly, you have to understand that mortgages today are sold in mortgage-backed securities. The lender that's taking the payments to servicing the loan does not necessarily own the loan. They don't have a unilateral right to go in and renegotiate the terms of that mortgage. So there's many counterparties involved in that decision. So it's not as simple as it looks.
That's a good note to end on, looking for a simpler, easier solution. We like to show some appreciation for our panel this morning. And I hope everyone will stay for our next panel, which is looking at the housing recovery and the economy in how much of a post-election priority it will be. A good opportunity to kind of further some of our opening comments from this morning. So please stay for that. Go ahead.
Thank you. Good to see you.
Looking at the one guy out there. Okay. Buddy, we're going to be starting our next panel here. If people want to get seated and I'll give them another minute. Okay, I'm going to go ahead and get started. We're going to take this opportunity to look at housing recovery in a post-election environment, how much of a priority it's going to be for all the different stakeholders. Here addressing that subject with me is Douglas Holtz-Eakin. Many of you know, president of the American Action Forum, our host here today putting on this event. And next to him we have Stan Humphries, who's been studying this pre-election and now will be doing it post-election as the chief economist for Zillow. I'm sure many of you are familiar with that. And perhaps from the more academic standpoint, we have Chris Mayer here as a professor of real estate at Columbia University. So with that, I'd like if you could start, Douglas, and tell us a little bit about what you feel like might be one of the big challenges that we face as we enter, the second term of the administration. What we need to look for in order to hasten a recovery.
Well, I think there are really two things. One is a good news and one is a less good news story. I mean, I think housing will drive the recovery in 2013. I think we're seeing across the country much firmer housing markets. I mean, we keep track of about 350 housing markets at the forum, and we have some measures of sort of the degree to which we're seeing price firming, housing starts, and employment growth in those markets, sort of the recipe you need to sort of see recovery. We're now sort of like 70% of them look like they're on track, and so getting year-over-year gains that are pretty substantial. So that's the good news part. We're going to see some of the broader economy get the benefits of the housing recovery and the things that come with it. The bad news is in Washington there is an enormous amount of work to be done. We heard about the QRM, QM, and now the Basel III Accords. There's a lot of regulatory impacts on the mortgage finance industry. That's far from settled. There's going to be the need to think about the future of the GSEs, and that's a topic that's very difficult and far from settled. It is our concern that they won't simultaneously think about the FHA, because what they've really effectively done is drive things from one government platform to another, and so they need to think about them comprehensively. Those are all very complicated topics, and the reality is, you may have noticed, this is not what they're spending their time on right now. They're spending their time on fiscal cliffs, and in the spring, they're going to spend their time on solving the debt problem in some more substantial way. So I'm worried this will get stacked behind these other policy issues, and that'll slow down substantially the ability to take out of the equation a ton of uncertainty about the future of the rules of the road in the mortgage finance industry, both single-family residential homes and the multifamily setting. So, good news, bad news story, I think.
Very, very mixed bag, certainly. What's your take, Stan, on like certainly a post-election challenge that we face in order to make the housing recovery a priority? A lot of competition to be the priority.
Yeah, absolutely. I mean, I completely agree that I think the legislative priorities are going to be really stacked around fiscal cliff issues initially, and then after fiscal cliff, I think we're going to be seeing a big round of probably tax reform, because I think a big part of solving the fiscal cliff issues will be around reforming the system of taxation in order to raise revenues in a way that's palatable to Republicans and Democrats alike. So I think probably our first quarter or two of legislative session next year will be tied up with those issues, meaning that GSE reform necessarily, I think, is going to have to come after that. So I think we're looking more at second half of 2013 before we could get to those issues. Now, I think we are going to make some traction on, Doug mentioned QRM and QM, so qualified mortgages and qualified residential mortgages. I think that those are now actually more in the regulatory and rulemaking process, so we'll see some traction there, even while we're still putting off decisions about what's going to happen to the future of Fannie and Freddie, and it's obviously very important. I do think that the lending environment, though, is going to look a bit better in 2013, even without making some progress on Fannie and Freddie. I think that what has Obviously, what has caused lenders to be more reticent than they might otherwise be has been the fact that home values for the past 5 years have been falling substantially. And of course, lenders are very reticent to loan against an asset that's depreciating, like housing has in the past 5 years. So I think that the stabilization we're seeing in markets right now, so according to Zillow's data, we nationally reached a bottom in home values late 2011. We believe we're currently up, home values are up about 3.2% from where they were last year, and we think they're going to increase over the next year a little bit less than they did over the past year. We think they're going to increase about 1.7% over the next year, which is still okay. But generally, we think we're going to see some below-trend performance in home values in the immediate aftermath of the housing bottom because we've got a lot of negative equity, elevated levels of foreclosures, and a lot of other issues. But so we feel, I guess, generally we've been fairly bearish about the housing market for most of the housing recession. Unfortunately, our forecast did prove to be pretty accurate there. We tend to be more on the bullish side at this point, although not as bullish as some. Where we think that we think we're in for a long flat bottom. We think we're going to be seeing 1 to 3% appreciation for the next 2 to 4 years, and before we get back to more normal appreciation, which remember normal is more like 2.5 to 5% annualized in real estate.
So I guess I'll hit on both comments that Dean and Stan had on this. The first, from a political perspective, I think we're actually going to see, there's the potential to see a lot happen, but I think we just shouldn't expect it to happen in Congress. Unlike Dodd-Frank, where some of the rules that are being set up are going to be challenged in court, even when the SEC has tried to apply some of this, we're going to be a long way off from the rulemaking taking effect. I think in housing, the combination of the control of the FHA through HUD and FHFA's control of Fannie and Freddie means there's quite substantial scope for changes in housing, regardless of whether there's any legislation at all. We know that Ed DeMarco has really, put his, as the Federal Reserve has tried to open the spigot, Ed DeMarco has basically put his hand solidly on the hose and squeezed it as tight as he could for Fannie and Freddie. Well, it is very likely that that he will not be the head of the FHFA in the not too distant future, and the person who is there is going to have an opportunity to decide how tight their hand is going to be on that hose in terms of the supply of credit, which is a lot of the things that people in the earlier panels were talking about. I think even the most optimistic person can't imagine private capital in the next couple of years getting to the point of even being 10 or 20% of the existing mortgage. If we hit 20% private capital, that would require massive changes in, and capital flows to do that. So I do think there are going to be some changes. I think those are a little bit hard to know at the moment until we see whether there's a permanent head of FHA. Carol Galante is acting right now, and whether there's somebody appointed at FHFA. So I think these are going to be regulatory. There's a lot of regulatory discretion in these areas that will play. On the housing side, I think this is sort of the inexorable sort of economic forces have driven the recovery in housing. People used to talk a lot about the U.S. and Japan, and one of the things they kind of missed in looking at all of the underlying structural issues and, the lack of policy, et cetera, or depending on your view, too much policy, there still are some really, really basic facts that drive housing. And the biggest one is population relative to number of homes available. And that pretty much is going to decide how much housing we have. There's a question of how to finance it. So whether it's going to be financed by homeowners getting mortgages or whether it's going to be financed by hedge funds buying homes and renting them, it's still got to be true that population growth in the U.S. is on the order of, household formation should be in the 1 million to 1.5 million range. We've been well below that for...
But we're back?
Right, but we're now back. Right. We've been well below that for 5 years, but there's a lot of pent-up demand. It's not just the household formation of the existing population. There are all the households that didn't form, the people who, the college graduates are sitting in, some of your homes, the, people who are doubled up and, pushing off forming households. They are going to form households. And, you know, the unemployment rate, underemployment rate affects people, but the vast, vast majority of the country does have jobs, and while they may or may not be making as much as before, those inexorable forces basically mean we need new housing. And that's, I think, makes me on the bullish side in terms of new construction. It also makes me on the bullish side in terms of house prices, because in order for there to be new construction, house prices have to get above construction costs. As an economist, it's really just a very simple calculation. Builders won't build until they can actually sell the home for more than it costs them to build it. And there's land prices in there in the mix. But what that means is, in order for this to happen, there has to be new construction. In order for there to be new construction, prices have to rise. And it's a very simple, how many households, how many housing units. So to my mind, this has been what's led to the recovery in housing, is just population growth. And it has not had nothing to do with policy or anything else. It's just market forces. And I continue to believe those market forces are going to be bullish, not bearish. And I think that's going to help the economy, because we're going to start to see construction jobs pick up and help pull the macroeconomy. So housing is going to turn into a tailwind instead of a headwind. And I think that's going to be true regardless of whether or not we fix some of the regulatory issues in Washington, although, as I said earlier, I'm somewhat optimistic that we're going to make some progress in terms of opening up credit a little bit.
I was just going to say, a quick point about the amount of price appreciation we've seen in some of these markets with high negative equity. I think if you'd asked most economists 2 years ago whether that was possible, I think your answer would have been generally a resounding no. You cannot get price appreciation in a market in which you've got 50% negative equity, like Phoenix or even Orlando market has about 50% negative equity right now. But you look at Phoenix, and we're seeing right now home prices rise by 20% year over year. You look at Miami, home values are up 8%, excluding distressed inventory, up 8%. And extraordinary levels of negative equity in the Miami market as well. And that would have, your conventional wisdom would have been you would not see that level of price appreciation. In fact, you are seeing it, and it's probably actually you're seeing some of it is probably because of negative equity. You have this stasis at the housing market where you no longer have people who are able to freely trade their homes. So essentially housing in some respects has become like a thinly floated public stock where you've only got 3% of the shares outstanding, and you get a little bit of demand coming into those marketplaces, and suddenly you have big price spikes because you don't have enough people who can get out of their homes to sell them to the new entrants in the marketplace. And that's been, I think, a real dynamic that you see in markets like Phoenix and Miami, and I think you're going to start, and Central Valley for that matter, and I think you're going to start to see it more in Vegas and soon in Atlanta and Chicago as well.
Yeah, that's a good point. And I think you wanted to
address...
I
just want to two caveats on. I mean, I'm closer to the bullish outlook that Chris has, but I think one thing to keep in mind is that the Federal Reserve is not going to stay with interest rates as low as they are
That's where
forever.
I was going next, interest rates.
That was a good question. And in fact, the quicker they fix the big debt and fiscal problems, the quicker the Fed can actually get out of the business of trying to be the only person pushing the economy forward. So if we get some structural reforms on that side, they'll exit more quickly, and we'll see a normalization of rates. And so you can lose a lot of money predicting when that happens, but it's not going to stay like this as long as they have claimed. I don't see we see this into 2015, things like that, if they get the fiscal house in order. So that's an important thing to watch. And the second is, I think, if you look at sort of the mechanics of what looks like QRM, QM, and Basel III, that puts a tighter box on credit availability. I don't think even the next FHFA person is going to be able to really loosen it as much as you might think. I mean, we wrote a paper on this. Andy Winkler's here and Cameron Smith. We put a paper out about a month and a half ago on this. And we might be wrong. We don't ever think we are. But it just looks to us like, the credit box is a lot tighter.
But so I think many of those regulatory issues aren't going to apply to this extent to the government-backed market. And the government-backed market is 90+%, and FHA is 50+% of new home purchases. And so the QM, QRM rule. I mean, look, I'm a huge fan of it. I'm not sure I'm quite as big a fan of the private capital as you are, but I'm very, very close. So my view is that the incremental funding for this should all be private capital. We should be evolving to a market where we have people who are holding loans at risk for the losses, not taxpayers, et cetera. So I'm completely in your camp in this regard. But I just think from a realpolitik perspective, not a what would we like, but what do the kind of existing framework look like? I do think that it gives heavy scope to policymakers, and they are going to be the incremental sources of funds for a very long time unless Congress acts.
Right.
And I just don't see the scope for Congress acting very quickly, because even if we didn't have the fiscal cliff, Congress hasn't touched the GSEs for a long time, and the fiscal cliff is going to make it harder, because Fannie and Freddie at the moment are generating significant profits. And if you get rid of them, they're actually generating profits at a time when you can just sort of pretend and not worry about it. And that helps the fiscal situation. And FHA, if you were to sort of shut down their lending today, has big losses on their books from legacy loans. So what is that going to mean? Well, we either have to put those on our books and pay for them, or we're going to let the FHA do more lending and lend its way out, which is the historical way that people deal with these problems. And so I think from both sides of the aisle, the pressure because of the fiscal situation is going to be to let these government entities continue to make money. And that's going to just make it easier and easier to not do anything and just fight back and forth with rhetoric.
Right.
In terms of legislative action, I might just add that it seems legislative actually has played the opposite role. They've actually been, administration arguably has been trying to pull the government more out of assistance. By lowering Fannie Freddie loan limits, FHA loan limits. Legislative action actually overturned the FHA loan limits, and the QRM-QM debates are likely to, they're getting torn there, where that's a direct tension there of, the larger people decry the fact that government's so involved and 90% of mortgages are backed by Fannie Freddie or FHA endorsed, but then they want the credit box on QRM and QM bigger, and those are directly in conflict. You can't have a large QM box and not also and simultaneously want the government to withdraw from the mortgage market.
Right. I would like to, as Douglas had pointed out too, what we've had here for recent months, we've had historic low interest rates. If the Fed gets pressure to push those up, how does that affect the Fannie Freddie pool? Do you then, are you going to have other investors then in the private markets, willing to take up more of that and doing what our first speaker today had talked about, shrinking the Fannie and Freddie inventory?
I think the best evidence is the Federal Reserve is having a very moderate effect on long-term rates. So if you look, there's problems in Europe, there's challenges in Asia, and the U.S. has still become a place where people see a lot of safety, and unless we go over the fiscal cliff for a while, even if we just kick the can down the road, I think the best estimate is, these are not mine, they're other people's, that we're going to still have low rates for a very long time because of global macro factors. And so even if the Federal Reserve, stops doing as much, I hope they do, cut back on some of, what is going to be a real challenge for the next Fed chairman, which is getting out of a couple of $1 trillion of long-dated securities. Even if we do, I don't think that means long rates are going up anytime very soon. But I still think even with all of the issue with rates, there's still just this how many people, how many houses, and houses have to sell at construction cost in order to house the population, however it's funded. And so those basic facts still sit on the table. And unless we go into another recession where people are going to double up and household formation collapses again, I still think that means that housing has to at least hit construction costs, maybe for smaller homes, fewer McMansions, things like that. But I still think that's got to be the best forecast. And that has prices well above kind of where we are today. And it means that housing, at least in the short run, is somewhat less sensitive to rates if we have to build the housing that we need to build.
Yeah, housing is extraordinarily affordable. You could take a fair bit of interest rate increase there and it'd still be insanely affordable. Yeah. Home prices nationally are back to, again, if you exclude distressed inventory, back to early 2004, late 2003 levels. And you pair that with the mortgage rates and, affordability is off the charts. Between 1985 and 2000, people spent about 20%, the median household incomes to buy the median valued home took about 20% of the median household income. Now it's down to about 13%. to buy the median household home, the median home. So it's just, you could take a fair bit of interest rate increase there and it'd still be quite affordable.
Speaking to that point, affordability, another thing that Mel Martinez brought up this morning on a more micro level that could be managed federally is eliminating the distressed inventory from comparables when you do the appraisals. And I think that would have an effect on affordability, on prices. I'd like to hear what you think.
We're guessing Stan has something to say.
This is right up Stan's out.
I bite my tongue during a lot of that. First of all, I think that in terms of appraiser regulation, if you look at USPAP and the regulations that appraisers use, my understanding, unless there's been some change in that formerly appraisers would not be able to use foreclosed homes, foreclosed sales at all. But the guidance was that if you're going to have to use foreclosed sales, which increasingly has had to be done because you have no non-foreclosed sales to use as comps, the guidance for appraisers has been you have to then adjust that foreclosure sale for the distressed pricing, the foreclosure discount itself. So that is already the guideline to understand for appraisers, is that if they're going to use the distressed home, they have to adjust it for a discount and then in the appraisal process. Now the question then arises, what is the foreclosure discount, where a bunch of numbers have been cited this morning.
27%.
27%, 25%. Well, the reality is that you get to those numbers, 25%, by looking at the median sale price of foreclosures relative to the median sale price of non-foreclosures. Well, it turns out that those inventories of homes are quite different. Foreclosures tend to be lower quality, smaller homes in less desirable areas, so you're really comparing apples and oranges there. If you actually do it on a apples-to-apples basis, we just released a report last week that actually did this. Nationally, the foreclosure discount is down to about 8%. I looked in Orlando. It's about I think it's about 9% in Orlando. Some markets like Vegas and Phoenix, there's no discernible difference between foreclosures and non-foreclosures. So the discount is a lot less than you would expect, and the reason that discount is smaller again is because once you true it up and look at apples to apples home sales, you find the discount is a lot less than you think it would be. So I do think that appraisers should be adjusting. If they're going to use foreclosure resales as comps, they need to adjust them to true arm's length full value transactions. The discount, though, might be smaller than you think it is.
Mm-hmm. But not use them unless you really have to.
That's right. If you have choices, you would prefer to use an arm's length full value sale to value a home versus a foreclosure discount.
Anybody else want to tap into that? That's Stan's area. We've got a little bit of time left. If anybody else in the audience has anything, I think, is that Barbara again back there? Yeah.
And I want to ask you a question.
I just wanted to know what you thought about the extension of the debt forgiveness for short sales that's supposed to expire at the end of this year. That we got a lot of deals that are in the works that are hanging on the cliff, and a lot of banks that are still dragging their behinds. So do you think we're going to get an 11th hour reprieve on that, and another extension for another year or something to get short sales cleared out rather than foreclosures? Because they move much faster in Florida than foreclosures do, and it cleans up our inventory a lot better.
No one knows sure, but I'm betting that happens. I mean, we have some must-pass pieces of legislation that's a very easy, bipartisan-supported piece to tack onto any of them, and my guess is that's what will happen.
There's been no action on it, though, which I've been surprised about. No discussion, to my knowledge, on it. I mean, I think it's a good idea, and it should be passed. I'm hoping the reason there's no discussion is because it's such a no-brainer that people assume that when the 11th hour comes, they're going to do it.
It loses money on the books as a tax thing, and so you don't want to talk about things that go the wrong direction, but there is a lot of support for it, and I think they're just going to stick it in and move on.
There's going to be some bill. There will be some bill that in the lame duck that it's a vehicle for. The administration certainly is internally talking a lot about it, so they know that this has to come through. There's also the safe harbor for servicers who are doing HAMP mods when private label securitizations also needs extension beyond this year. So I think those things are that one will be a little more controversial, but only a little bit. I would also sort of toss out one other idea, which I think is sort of, I think, has some potential that you probably haven't read about, or you've read about but haven't believed, which is the idea of trying to work with some of the private label securitizations for deeply underwater borrowers. I think there are some things that are starting to be quietly discussed that are likely to potentially have some traction to have the private label securitizations do refinancings on those deals. And that may require legislative action, but it's possible that there could be some interesting compromise in that area. That would be very, very helpful in Florida and California and Nevada.
Would you see principal reduction as part of that?
Yeah, it would actually be principal reduction. One of the interesting things about those private label securitizations, if you take somebody who's 140 LTV and you ask a group of investors, what would you be willing to take for that 140 LTV loan that's current? Most investors would be really happy to get 90 some odd cents on the dollar for that if they could get it in cash. And so they would actually be in favor of doing that. In fact, some of the banks have been more aggressive at principal write-downs. The GSEs have done none of them, but banks with their own loans have actually refinanced some of those at a lower rate. But the private label securitizations can't do it. These are people who took out anything subprime, Alt-A, even jumbo loans during the crisis. And there is some scope, given that investors would actually like to see these things, they would be willing to accept principal modifications. The question is what's the mechanism and how to do it, but I think there's scope for an agreement here. There's a lot of stuff that would need to be done, but there is some scope for an agreement that might be palatable both to investors and homeowners. And servicers might also find attractive. So I think there's some smaller kinds of things, but here that wouldn't be very small, that could really help.
And I believe you had a question too.
Yeah. It dawned on me during the last panel when there was a discussion on sort of recovery in the core versus some of the outlying areas. There's been this sort of presumption, right? I'm guilty of it, that we had a boom and then we had a crash, and now we're just waiting for those crashed areas to recover. Is the geography of the crash and the geography of the recovery the same, or are we seeing, these shifts in real estate markets across the country? So that while we see housing starts and we see some prices, they really aren't in the same places we saw the crashes. Is that a knowable answer?
Oh yeah, definitely. Zillow's data is for 369 markets in most every zip code in the country. So. Generally, the housing recovery is fairly uneven. It's uneven across metropolitan regions where you've got, Atlanta is still struggling, where you've got Phoenix up 20%. We generally, though, at the metro level, you do see some of the strongest recoveries in those markets that are hardest hit. Right. And of course, the logic there is pretty obvious. It's affordability has become so extreme in places like Central Valley of California, many Florida markets, Vegas, Phoenix, Detroit, that's what is igniting now mainstream buyers to get off the fence. Plus, there's a huge portion of investor-led purchase activity in those markets. So if you look at Phoenix, anywhere from 30 to 50% of purchase demand in Phoenix is coming from investors right now who are basically taking a housing stock that was oriented towards a home ownership rate of 69% and arbitraging it and converting it into a housing stock that's appropriate for about 64% home ownership rate. Which is what we need to have done, because long term we're going to be at probably 64% home ownership rate, which is fine, which is where we have been historically. But even within metropolitan regions, you see a lot of unevenness. You look at San Francisco, which is actually doing fairly well at the metro level, but Palo Alto is up 18%, and Vallejo is just barely scraping by. It's very flat, and you actually see that. And then when you think about kind of periphery versus urban core, the peripheries have had it really hard, because those are the places that typically went into decline first, because that's where new supply came online. So in the periphery of Orlando or any of the large metropolitan markets, that's where you could build new homes, and then when the market nosed over, that's where you were left with these real acute imbalances in supply and demand, and home prices just tanked there. And unfortunately, those are some of the last places to emerge from the housing recession as well, because home prices are more affordable in the core now, so given your druthers, people are preferring to move closer in. So that we're seeing still, nowhere is that more pronounced than in New York. Where really, Manhattan barely had a housing recession. And as you radiate out from Manhattan, the 5 boroughs are a little bit worse, but still pretty positive. When you head out into New Jersey, it's pretty bad out there.
Yeah, you do have to wonder what $6 a gallon gas prices would have done to the recovery of the periphery markets. You know, that's probably been very fortunate for those areas that, you know, they haven't had to deal with the high gas prices.
One thing I would add to Stan's comments, which I think I completely agree with, is just people should also have should think a little bit harder at times about what they think expectations should be. Home prices in the long run have very, very persistent trends. So if you look at the West Coast, East Coast markets, house prices over decades have grown after inflation 2 to 3%. And every peak is higher than the peak before. And I think in those kind of markets, we can and should expect that house prices will eventually eclipse the peaks they were before. It is very, very different in places where there's a lot of demand, where there's a lot of land for construction, where historically prices have grown much more like construction cost. And so when prices start to rise up to a point, we're going to see a lot of construction come online, and that construction is actually going to cap what appreciation is. And so in many places in Florida, I think the expectation that we're going to get back to the peak where we were isn't a realistic expectation, whereas in the Northeast and California markets, it's a completely realistic expectation. In Seattle, where you are. And so setting expectations appropriately, looking at kind of supply and demand for land, are really important issues. And construction costs are going to start really cheap. You know, Hurricane Sandy will bring some construction workers up to the Northeast, but, you know, there are going to be people who are willing to work. You know, builders are going to be able to do things pretty inexpensively at the moment.
And I think globally, we haven't seen, you know, the building in China that we had before, where construction costs peaked so much at the peak. So that's kind of another mitigating. Yes, sir. Trevor, I believe. Yeah.
One observation that I have with regard to costs is that we have no effective guest worker program in this country, and this administration has been very tough on illegal immigration. And in the hot areas of Orlando, where I'm a land guy, we're seeing trusses sitting on the ground because they can't find the crews to put them up in the air. And it seems to me you're going to have a considerable amount of cost push on the construction side if we don't bring about some type of effective guest worker program.
This is true. We're actually, even though we were one of the most depressed markets in the state here in the country, in Orlando, you're actually now seeing the time it takes to construct a new home tick up, and that's largely due to a shortage of skilled labor.
Right. I would sort of say there are a large number of unemployed male unskilled workers in this country and in these areas as well. And I do think that we're going to have to figure out how to bring some of those folks back into the labor force again. That's a completely separate conversation. But construction was a big area of employment for some of those folks, and I think that we need to hope that we can figure out how to do that again, because otherwise we're going to have a lot of issues recovering from the recession.
And those guys don't want to hang drywall.
And your questions are really focused around the cost side of immigration reform, and there's also a substantial demand side implication for immigration reform in that, you know, between 2003 and 2007, I mean, a huge part of what was adding demand to the housing market was coming from immigration to this country. Now, a lot of that immigration was probably illegal, but a lot of it was legal. So I think as our economy heats up again, both of those illegal and legal immigration will start to pick up again, and that's a big part of where housing demand will come from.
Right. But the wages on those jobs are a big issue, but those are going to have to kind of get worked out, because we can't, on one hand, have a large segment of the population that doesn't get employed, on another segment have people coming in. You know, how to work those things out are going to be, you know, big issues to think about. I'm not making a view one way or another on immigration, just that these are in other conversations, if we had a different title of panel, would be important issues to think about.
Okay, one more question. Go ahead.
Yeah, real quickly. Let's go back to the Fannie-Freddie discussion for a second. I think that we all pretty much agree that one of the contributing causes, and this question is for anybody who wants to take it, but one of the contributing causes of the issues we've got is Fannie-Freddie got away from their charter. They started buying subprime mortgages and holding them directly in their portfolio. They pushed 100% loans that lenders had to make. And I think that I would like to see if there's any support for a Ginnie Mae model to replace the unsustainable model that Fannie and Freddie represent right now, where the initial risk would be taken by private capital, and the government would only assume any risk in case of enormous default, and only then will we find true price discovery of what that credit risk looks like today, because right now it's pretty much subsidized by the government, and we know that's not going to work. So the Ginnie Mae model seems to me like it might work, and I'd like your comments on that.
Well, I at least think there's a lot of sentiment for that, and when I hear about these discussions, and where you just have, a variety of different proposals on tiering the risk with the equity investment up front, and the debate over the quality of the mortgage is that, then the lender holding onto a slice, and then the private securitors having some, and then the backstop being the government, and then the government backstop being on the instrument, not on any institution, so that you avoid what we had in Fannie and Freddie. And I think it's very sensible that we end up with something like that. Getting the details right is going to be very important, I think. About the only thing that I think people have to think harder about is the role of the portfolios in the multifamily space. Stan and I were talking about this earlier. It's been my pet theory that they should do reform of the multifamily GSE piece first, because it's less politically contentious, it's important. And then they're not identical, because there really was a much bigger need for that portfolio as providing liquidity than you had over where they were just stacking up these securities as a big hedge fund. That's something they're going to have to work out. But in terms of the backstop, I think most people are going exactly where you're going.
What do you think, Stan?
Well, yeah, I totally agree. I mean, in terms of, what's going to be politically saleable is going to be one where, of the three alternatives the administration trotted out more than a year and a half ago now, of different options for what GSE reform could look like. Clearly we're going to head down more of a middle path where we don't have, a complete, backstop from the U.S. government, but we've got some backstop that is standing behind private capital. And of course, Dodd-Frank has started to work towards some of this with the reserve requirements of lending, where lenders are going to have to keep some skin in the game as they securitize that on, which I think is probably a helpful change that we didn't see during the run-up, and that did cause some problems, where it then creates perverse incentives for originators to perhaps originate mortgages that aren't going to have good properties in terms of default rates long term. So I think that we're already seeing that in terms of some of the guidelines that are coming out from Dodd-Frank. But in terms of what the future picture for securitization looks like, I completely agree that I think the only thing that's going to be saleable, that you're going to be able to get conservatives and obviously, I think the more progressive you are, the more you want a government backstop, and you want to be able to facilitate a 30-year fixed mortgage. And the more conservative you are, the less you want the government involved in making that happen. So they're going to have to find some compromise where you can have some backstop that still facilitates a 30-year fixed mortgage, but reduces the amount that the government, protects the government's backstop with private capital first.
I would just sort of say I don't agree with your premise, and I think most academic policy research has come down against the view that Fannie and Freddie caused the housing bubble, or were significant contributors to it. There were trillions of dollars of subprime securities floated. Fannie and Freddie owned a fraction of them, and if you add up all the loans they had, it was nowhere near a large amount. And if we look globally, there were housing bubbles in Spain and Ireland and many other countries that had no Fannie and Freddie. No one ever heard of them. So I think the problem with Fannie and Freddie has been, once the crisis hit, it cost us $150 billion, a complete lack of confidence in the market, and it was a terrible structure to recover. And so we watched our supply of credit get completely eviscerated in the downturn. So I sort of think that reforming Fannie and Freddie is critical. I think we all agree with that. But I think the evidence is completely counter to the view that Fannie and Freddie caused. And there have been a bunch of studies that I could cite on this. But I think the critical path going forward, which is, I view that mostly as academics debating and maybe some, policy wonks. But I think the going forward part, everybody's in agreement with the basic premise. I think most people, the vast majority of people outside of the American Enterprise Institute would say that some kind of government backstop is going to be a part of that. But private capital has to sit in front and face real big losses on on the on the new loans and help try and discipline the process better. And if we do that, I'm sure there's a bipartisan place to be had on that. But I'm not sure the political rhetoric is going to allow us to pass that.
I can't resist picking up two things on this. First, on Chris's point about what caused the crisis, I had the great honor or misfortune, depending on how you look at it, of serving on something called the Financial Crisis Inquiry Commission, which was created by Congress and appointed on a bipartisan basis. And we spent a year and a half plowing through all the evidence. And I concur with Chris's point about the fact that in a wide variety of regulatory settings, in a wide variety of mortgage finance settings, we saw housing bubbles around the globe. And I was never a fan of the views that said, it was bad U.S. banks. Some people on the panel, evil bankers did it. And then we had some people, it was evil policymakers. It's a much more complicated and nuanced episode. And then on this issue of how we go forward, which is really the key question, there is this view among conservatives, the crazy people I run with, many of them believe deeply that we should just get the government out of this entirely. And the problem with that view, I think, is that in the next crisis, there is no Congress that won't step in. It's just unimaginable that things would go south in the housing markets broadly, and the Congress wouldn't do something. So if you're going to have the government in there as a backstop, it'd be way better to plan it in advance and do it in a sensible fashion than to have Congress make it up on the fly. And I think eventually we're going to come around to that point of view, and that's where the political consensus is finally going to arrive. It's just going to take some time, and that's why I think places where the backstop's less important, like the multifamily space, would be a good place to go first and get something done while that, sort of slowly evolves.
That's such a vibrant market now that you actually could do something with it, and it probably wouldn't hurt it that much.
Yeah, and multifamily is going to be hugely important because, as I said, our transition from a housing stock oriented towards 69% home ownership is not yet complete. We're at 65.5, right now, home ownership rate, and it'll go lower. And a lot of these people that Chris referenced, by the census estimates last year, 22 million households were doubled up with one another and across this country because of during the economic recession. A lot of where those doubled up households will move first will be into rental stock. So we've got to, and that's what of course is fueling all the rental demand we're seeing now. Rental prices nationwide are up about 5%. According to Zillow's data, markets where we're seeing a lot of foreclosure activity like Phoenix and Miami, the rental rates are up even more. So, that rental dynamic, that investor dynamic it's got another year or two at least legs, where investors will find attractive opportunities in servicing that space. But I do think a multifamily strategy is a big part of that because as the economy improves and people move out of doubled up housing situations, rental accommodations are going to be a huge part of that. So we need to get ahead of it.
So I can't help but throw one quick comment in, which Senator Martinez started his talk with but didn't really sort of answer. And I think we're going to at some point have to come back to this sort of question of how to think about home ownership in this country. And I'm going to make the small pitch that I think there's still really important reasons to help facilitate. I didn't say subsidize, but I did say facilitate home ownership because we're not going to get out of our retirement issues and savings issues in this country if we don't think about that. People who are going to hit retirement who do not own their home end up in poverty and disproportionately on the dole of taxpayers. And they're incredibly costly from a Medicaid perspective. They don't have resources to deal with other kinds of problems. And just every piece of data in the world says that somebody who owns their own home outright without a mortgage when they hit retirement is in a very, very different financial place. And I think the stability associated with home ownership and the ability to hit retirement with assets that are otherwise going to have to be provided by taxpayers is really important. So we need to figure out a way to facilitate that in a responsible way without subsidizing it. But I think if one looks both in the U.S. and around the world, home ownership is a good thing. You could talk about communities. The evidence on that is a bit more dicey. But purely from a financial perspective, there are many positives. And I think it's crazy for low or moderate income households to pay, 12 to 15% of home value in rent, which is what most of the models for these private equity funds are doing. I don't think that's actually a real solution either for those households or anyone else. They're supposed to be buying homes, putting sweat equity into those places, maybe smaller non-McMansion homes, but nonetheless, there are just many, many reasons why I think we should and can be supportive of policies that facilitate home ownership with savings in a responsible way.
Clearly, a lot at stake in the long term for the financial health, not just of the country, but even of homeowners who, could end up without equity and suffering through the finances of being renters for the rest of their life. Okay, real quickly, we're going to wrap it up. I'm going to make each of you choose whether or not for the next 4 years you are bullish or bearish. In a word, Chris.
Bullish.
Compared to who?
Compared to the last 4 years.
Oh, bullish, definitely.
Yeah.
Bullish.
Okay. With that, I'd like to hear a round of applause for our great panel.
That was the right question.
Thank you all for coming. They're available for more questions.
So I want to take the host prerogative of closing with a few remarks. First, we've now held these kinds of discussions all across the country. We did them in Las Vegas, Phoenix, Sacramento, Columbus, Ohio. We've done one in Washington, D.C., and now Orlando. And it's been a tremendously educational experience for us. We learn more probably than people learn from us. But it does remind us of just how, housing markets are local, and the nuances and differences in everything that goes on there has just been remarkable. And it's and I want to thank you for coming today and providing that education. So my first thanks to you. I do think we should thank all the panelists, myself accepted, who provided real insights. And I think we give a big round of applause to Mary for moderating both panels.
Thank you.
And then I want to close thanking again the Senator for his opening remarks and acknowledging that none of this would get done without the staff at the American Action Forum, Sarah Shook, Noel Clemente, Cameron Smith, Andrew Winkler, who do all the work and then tell me where to sit and what to say. Thank you very much. We are adjourned.